I'd love to bring in some of our guests so we can talk about it a little further. We have Jan Kniffen, J. Rogers Kniffen, WWE CEO, and we have Michael Baker, D.A. Davidson retail analyst, joining us now. Jan, I guess, you know what, let's start with Macy's. Obviously, you previously worked for a part of the company that then eventually became Macy's. What do you make of this possible forward development between Macy's and activist Arkhouse Brigade?
Well, when all this started, I said there was about a 30% chance this is going to result in a deal. Then I went to 40% as they got a little higher on the price, and now they're talking about due diligence. Maybe it's a 50-50 deal now. So, yeah, it seems like we're getting to the point that Macy's board could maybe get to the point of saying yes. It'll depend on how much leverage they're really putting on the company and how high the price can get. And when you're trying to keep the leverage low and the price higher all the time, it makes it harder and harder to get the deal done, but it also makes it more and more likely to get the deal done as the price goes up. So, yeah, I think that this could really happen now, and we could see a restructuring from the point of view of trying to make the real estate values evident out in the world, right? That's been the problem the whole time. The real estate's worth a lot. They've never been paid for it. Arkhouse thinks they can get paid for it.
I mean, and that is the question. And obviously, the deal price is one thing, right? And you want to do right by shareholders. It's your fiduciary duty to entertain these offers, and maybe that is the best deal that's out there. Maybe they will up it once they get some of this information, if indeed they get it from the due diligence, if this confidentiality agreement is signed. But this group doesn't have any previous history running a retailer or really running any company. So what happens, I guess, to the company itself? And then as a follow-on question, this is not the first activist that has tried to unlock the value of the real estate and admittedly, again, has less experience than others that have tried to unlock the value of the real estate with Macy's. So why could potentially this one make sense to do both of these things, run the company and unlock the value of the real estate for investors?
Well, Court, I looked at OpCo-PropCo transactions for 20 years, every time, whether we needed to or not, to make sure there was no way to unlock the value of the real estate. Will they get it done this time? Maybe, but it puts an enormous amount of pressure on the operating side of the business as you bring those stores to what basically amounts to full rent, right? And so you really reduce the earnings in the operating side of the business. You make the real estate worth more. If you can do it really carefully and make it all work, in theory, you can drive more value out. Remember, somebody tried to do it with Target, whose name shall remain anonymous, and somebody tried to do it with Macy's before, and we tried to do it with our businesses. They're really hard to get done and make work. And remember, the last time Campo did this with Macy's, which was called Federated at the time, they went into bankruptcy. So you're always fighting the battle of, can you make the operating business still be healthy enough and work? And when the operating business right now is going through a time when they're trying to make it better already, right? It needs improvement now. It's not like it's running right at the top of its game.
Right. Michael, I want to turn to you and talk about Dick's Sporting Goods. Obviously, those shares rocketing higher here this morning after they put up a really strong quarter. I spoke with Executive Chairman Ed Stack, and he said, look, we're fortunate enough to be in this place right now where we've repositioned the business in a way that our consumer, their kids in sports and equipment, we're giving them the best opportunity to succeed. We're giving them what they want. And then I loved this. He said, in retail, loyalty is the absence of a better alternative. And right now, we're giving them the better alternative. I mean, is it as simple as that? They just have the right merchandise at the right time for when people need it? Or what is the secret to Dick's Sporting Goods success right now?
Yeah, it's really been a great turnaround story, we think. And versus pre-COVID, their margins are up more than 2x. They're not the only alternative, but we do think they are the best alternative. And as they've gotten bigger and better, they've gotten more access to brands, better product from the brands, and that continues to separate them from the competitors. They've also done a great job with their loyalty program, so that helps gain share and bring customers back in. So really, the double-digit margins that they're able to sustain here shows the strength of the turnaround versus pre-COVID when their margins were about 5%. Sporting goods is a tough business, but they're executing well and taking market share.